This is part one of a two-part video on defined contribution plans. In this video, I'm going to discuss what a defined contribution plan is. I'll show you the benefits of tax deferral, and lastly, give an overview of some of the common investment choices. Hey everyone, this is Michael Todorich and thanks for tuning in. Just a quick note on the video before we get started. These videos are designed to complement my book, Running the Numbers, a step-by-step guide to life's major financial decisions. Each video corresponds to a chapter or section in the book, and the idea is to review these chapters and use the videos as a platform to add some additional color around the examples where it just wouldn't have been practical to do in the book. So to check out the book or additional videos, please visit my website at michaeltodorichfinance.com, and there's also a link to the website and the book in the description below. So, defined contribution plans are the most widely used type of employer-sponsored retirement plan in the United States. And in part one of this video, I'm going to explain what a defined contribution plan is. And as these plans are typically tax advantaged, I'm also going to show you how to calculate the benefits of tax deferral and then give a review of some of the common investment choices and their differences. So what is a defined contribution plan? So this is an employer-offered retirement plan where an employee contributes a percentage of his or her salary into a retirement account. And these plans are usually tax advantaged in some way. Typically, the contributions are tax deferred, with the money being restricted for some period of time, and the employer will usually match the employee contribution to some extent. Now, in the United States, some of the more common types of defined contribution plans, and you've probably heard of these, are the 401k, the 403b, and the thrift savings plan. Now, the plans themselves are actually very similar, with the main difference being the entity that offers them. So, for example, the 401k is offered to employees of for-profit companies, the 403b is offered to employees of nonprofits, and the thrift savings is offered to employees of the U.S. government. The 401k, 403b, and thrift savings plans all have similar features in that they allow employees to contribute a portion of their salary to their retirement accounts on a pre-tax basis. In other words, before they pay taxes on it. And then that money is allowed to grow tax-free until the funds are withdrawn. Now, the funds are restricted for a period of time, unless under special circumstances. You're not allowed to take the money out without incurring a penalty until after age 59 and a half. At that point, taxes are paid at the individual's ordinary income tax rate whenever the funds are withdrawn. Now, if you're looking for more details on the different plans, I recommend visiting the Plans section of the Internal Revenue Service's website, or CNN Money's Ultimate Guide to Retirement is a pretty good resource as well. So let's actually jump to CNN Money's Retirement Guide and take a quick look. So you want to go to money.cnn.com/retirement/guide. And you can see they cover quite a broad range of topics, but for defined contribution plans, you specifically want to look at the 401k and company plans section in the top right. And if we click on that, you can see it has quite a long list of frequently asked questions around defined contribution plan basics, and then it deep dives into all of the different plans. So as I mentioned, one of the main benefits of defined contribution plans is that you can contribute money on a pre-tax basis, and that money is allowed to grow tax-free until your funds are withdrawn. So what I want to do now is look at this in a little more depth and go through an example and show you the huge benefit of tax deferral. So first, let's make a few assumptions. Let's say you're 25 years old and you have $10,000 of pre-tax income to invest. And your options are to invest in your employer's defined contribution plan or pay taxes now and invest the money at your local bank. We're also going to assume that either investment will pay you a 6% yearly return, and you will reinvest all returns until retirement at age 60, and your current and retirement tax rate is 15%. So first, let's look at what happens if you invest in your employer's tax-deferred plan. And so to see what that $10,000 will grow to in 35 years, we need to do a future value calculation, which, if you remember from the previous videos, is just a compound interest formula. Now, if you're watching my channel for the first time and you're not familiar with the compound interest formula, please see the link above to Chapter 2 for a review. So let's go ahead and plug those assumptions into the compound interest formula, which is the principal times 1 plus the interest rate to the power of the number of periods, which is 10,000 times 1.06 to the 35th power. So the 10,000 will grow to $76,861 after 35 years. Now, we still have to pay taxes on that money whenever it's withdrawn, and remember that from the assumptions, the tax rate is 15%. So we multiply 76,861 by 1 minus the tax rate of 15%, and that gives us an after-tax amount of $65,332. So by investing in your employer's defined contribution plan, the money will grow by roughly 6 times the original amount invested. Now let's see what the $10,000 will grow to if you invest it at your local bank. Now, because the money is not being contributed to a defined contribution plan, you'll not only have to pay ordinary income taxes before you can invest, but you're also going to have to pay income tax each year on any gains you receive from the investment. So let's break this into 2 steps and first tackle the initial investment. And as your current tax rate is 15%, we'll multiply the $10,000 by 1 minus the tax rate, and you'll be left with $8,500 to invest. Next, we need to apply the tax rate to your interest rate, in other words, your yearly return, and this is 6%. And this is because each year, as you make a return on your investment, you're going to have to pay some of that return to the government as taxes. And it effectively lowers your return. And we can see how much the return is lowered as follows. We'll multiply the interest rate of 6% by 1 minus the tax rate, which is 6% times 0.85, which lowers your return to 5.1%. So now that we know the after-tax initial investment and the after-tax yearly return, we can put those numbers into the compound interest formula, which is 8,500 times 1.051 to the 35th power. And you see the investment grows to an after-tax amount of only $48,475 after 35 years. So due to the tax drag, in other words, the additional taxes paid over the life of the investment, from investing in a non-tax deferred account, your investment is reduced by $16,857, or by about 25% versus if you had used a tax deferred account. So as you can see, the benefit of tax deferral is huge. Now, these calculations are fairly straightforward, but if you want to see the calculations in more detail, you can reference the accompanying Excel in the Benefits of Tax Deferral tab, which can be found on my website, michaeltoldrichfinance.com. So now, let's assume you've run these numbers and you've decided, hey, I'm going to go ahead and participate in my employer's defined contribution plan. The next hurdle you're likely to run into is choosing an investment option. And typically your employer is going to have a range of different investments to choose from, and that'll be some combination of money market, bond, stocks, etc. And so what I want to do now is review these different types of investments, and let's start with the money market. So a money market fund puts your money in highly liquid, in other words, easily convertible to cash, investments. And these investments have the lowest risk and consequently the lowest return. And really they're used as a place to park your cash so you can generate some small return versus just holding your money in a bank account. So next let's talk about bonds. Bonds are loans made by an investor to a borrower where the borrower usually pays a fixed payment over the life of the loan. And bonds are a great source of steady income, and investors have a huge range of options, including government bonds, which are also considered to be risk-free because the government literally has a money printing press, to investment-grade corporate bonds, which are issued by the most credit-worthy companies, all the way to junk bonds, which are corporate bonds issued by the least credit-worthy companies. Now, as risk and return are positively correlated, government bonds, being the least risky, are going to give you the lowest return, and junk bonds, being the most risky, will give you the highest returns. And the bond market is really wide-ranging, and there's far more out there about bonds that I can cover in this video. But if you want to learn more, Moody's.com or S&P Global.com are both great resources, and you can check out their websites via the links in the description below. Now, the last investment I want to talk about is stocks. Now, stocks represent partial ownership in companies and entitle you to a portion of the company's assets and their profits. Now, unlike bonds, however, where a periodic fixed payment is received, owners of company stock are actually compensated in one of two ways. The first is capital appreciation. In other words, the increase in the stock price. As a company makes more money, its value will increase, and the stockholders should be able to sell the stock to other investors for a higher price. The other way you're compensated is from dividends. And dividends are when a company pays out a portion of its earnings in cash to stockholders. And stock funds come in an almost infinite variety, but typically they're available in one or some combination of the following 5 categories. So the first are growth funds, which focus on companies that are growing faster than the average for their industry. And these stocks, they typically don't pay a dividend, and profit is usually made through capital appreciation. Next are value funds, which include companies that are undervalued versus their peers, and these companies typically pay a dividend, and profits are made either via the dividend or capital appreciation. Next are sector funds, and a sector fund concentrates on a specific sector of the economy. So to give you an example, a sector fund could concentrate in technology, energy, pharmaceuticals, etc. You also have market capitalization funds, which will hold a certain size of companies. So, for example, they're usually broken up into small, medium, and large cap. You also have regional funds, and these contain stocks of companies in a particular region of the world. So, for example, United States, Europe, Latin America, China, etc. And then the last fund I want to mention is a fund called a target date fund. And a target date fund is actually a combination, and it can have stocks, bonds, and money market. And what a target date fund does is, based on a target date you set, and this is typically a retirement date, it will automatically shift your portfolio allocation between cash, money market, bonds, stocks, etc. to generate the maximum return with the appropriate level of risk as you age. So as you get closer to, for example, your retirement date, the fund will automatically update the asset allocation more conservatively, in other words, to less risky assets. And as bonds provide steady income, they're less volatile than stocks, the allocation typically shifts more towards bonds and cash or cash-like instruments and away from stocks as you get closer to that target date. Now, I kept this section fairly high level, as going into details on the different types of investment funds is a bit beyond the scope of this book. But if you want more information on what a bond or a stock is, or the different types of funds, again, I recommend checking out CNN Money's Ultimate Guide to Retirement to dive deeper. So let's actually jump back to CNN Money's website and take a look at where on the website you can find this additional information. So if you look on the left-hand side under the investing section, you can see you can get more detail on any of the different investments. So now that we've reviewed the different types of investments, the next thing you'll need to do is choose the type of investment fund. And investment funds typically come in 2 types, active and index. So in an active fund, the managers of that fund will use a proprietary investing strategy to try to earn a higher return. And management fees are typically higher because you're paying for the manager's skill and the potential for higher returns. Now, index funds, these are also known as passive funds, track the performance of an index. And an index is a theoretical portfolio of investments in some segment of the financial market. Now, because you can't directly invest in an index, in most cases you have to invest in an index fund if you want your investments to mimic the performance of whatever index you're trying to track. Now, as a caveat, if you have enough money and the investment expertise, you could theoretically purchase all the individual securities yourself and replicate the index. But normally, people go through an index fund that will purchase the stocks or bonds and adjust the asset allocation as needed to replicate the index. And some of the most well-known indexes are the S&P 500, which is an index of the 500 largest companies in the United States, and it generally is accepted as a representation of the US stock market as a whole. You've probably also heard of the Dow Jones Industrial Average, which tracks the 30 largest companies in the United States. And the biggest benefit of index funds is their low management fees. And this is because in an index fund, the manager's only job is to mimic the index. So there's no proprietary investing strategy they're employing, and you're really just paying for someone to administer the portfolio, and as such, management fees are kept to a minimum. So that takes us to the end of part 1 of defined contribution plans. And in part 2, I'll show you how to calculate the impact of management fees, also discuss the differences between a Roth and a traditional retirement account and how to quantify which one is optimal. And then lastly, I'll touch on how much of your pay you should contribute to an employer-sponsored plan. So to check out part 2, you can click on the thumbnail to the left, or for other videos or additional information about myself or the book, see the links in the description below or check out my website at michaeltodrichfinance.com. Thanks for watching.